Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. The stock indices have set new all-time highs, while at the same time, oil prices have surged, triggering higher inflation. So how long can this last? And AI is facing a PR problem, and is it a good time to buy bonds? Some opinions are coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, Michael Godwin of Fergasso Financial Advisors, and there's one more spot at the table, and it's occupied by Kristen Hemmings of Coghill Investment Strategies. Kristen is joining us today because Carrie Coghill could not be with us. So, in the last 2 weeks or so since we last met, the NASDAQ, the S&P 500, and the Russell 2000 all set new all-time highs. Now, in the past couple of days, they've backed away from those all-time highs a little bit, nothing significant. But with the markets are up and earnings have been strong, but there have also been some headlines from the past week or so. Consumer sentiment fell. Inflation soared to 3.8%. Retail sales growth cooled. Housing market for the spring is shaping up to be a bust. Gasoline prices are still very high. Those on the surface don't portend a very vibrant economy. Now, we've talked about the K-shaped economy before. Michael, you've brought that up several times. It's with those with money are spending. Those that don't have that much money are being hit hard by all the rising costs. And we see two divergent lines, one going up, one going down. So my question is, how long can this continue? How long can it last? Consumer spending has been touted as 70% of the U.S. economy, boosting that up by 70%. But can this one demographic of people who have the money prop up the economy? Or has the economy changed? Or are we just looking at artificial intelligence as the main drive now of the economy? Or am I missing something else? Anybody want to jump in? Go right ahead.
Can I talk first?
You sure can.
Great. Okay. So today, Home Depot, which I think is one of the meeting places of the world, because no matter what your demographic is, you're going to end up there one day to get something for your house, apartment, whatever, even dorm room. Okay.
I was there
It is
yesterday,
the
Kim.
great leveler. So their sales were good, and they are saying that people are generally shy about the big projects, but they're rolling on with the regular maintenance, which that's really great in this high kind of cost area that we find ourselves in. I'm hesitant to call it inflation quite yet, but there's pressure all around, and yet the consumer, they complain and they still spend. And I think that is the story here for much of this, is that if people are employed, they can be happy, but they're unhappy, but they're still going to spend. That's my 2 cents.
Yeah, I agree. I mean, we talked about the K-shaped economy, Stacy, and we're still in that. We even with the price inflation we've seen, mainly on the backs of larger oil prices, the consumer still they're either biting their nails and spending, and having to deal with it because they have no other option. But at some point, this is going to be a problem, I think, particularly with regards to the oil markets. You're seeing spot prices for oil, meaning oil today, very high, but the futures market is still relatively tame, relatively low. So the market does think that the war will end at some point in the not so distant future. If that doesn't happen, because the economy is still pretty strong, I think you're going to need to see oil. You might likely see oil or gas prices, let's talk about gas prices, above $5 a gallon pretty easily before there's some demand destruction in the economy to really pull back on consumer spending and whatnot. So I think a lot hinges on what happens in the Middle East to a large extent. But you're right. I mean, we talked about this last week. You've seen consumer sentiment hit sort of all-time lows at the same time that the stock market has hit all-time highs. So there is a paradox there regarding the economy and the stock market, and that kind of goes back to sort of the K-shaped economy, where those who are spending a lot in the economy continue to do so and continue to drive I guess, profits for a lot of companies and whatnot. That doesn't look like it's going to stop anytime soon, but I think it does run the risk of slowing down at some point, maybe later in the summer.
Yeah, you raise a very good point. I'm just looking at one headline. The oil shock is causing a $45 billion rupture in the economy. It can't continue, can it, Kristen?
Well, really, I've heard more and more about this K-shaped economy migrating to an E-shaped economy. And as much as I love the economy being named after Kim and I, the E is taking hold. And that really is where you have your top spenders who are very resilient, who are driving a lot of consumer spending. We know lower income folks are really struggling in this type of economy where grocery prices are high, gas prices are high, and they're having to make really hard choices about what they spend their food on. So now it's the middle class that really is determining, are we going back to K, how long can it last? Middle class consumers are nervous, as Michael pointed out. They're kind of gritting their teeth and spending money, but it's a difficult place to be because they are starting to make some decisions based on less travel, maybe value shopping at the grocery store, hitting up Costco more than typical. So how does it end? There's either the middle class finds some stability. We have the war in Iran cool, their gas prices or energy prices maybe reduce a little bit, or there has to be government stimulus. Either the bottom falls out of all of this, or there's some type of stimulus or stabilization that gets us back into a normal spending pattern.
You're the first I've heard to mention government stimulus over this whole thing. Frank, your thoughts?
Well, there's one other thing that's beginning to become problematic. In spite of what the president wants and what the Fed is doing, interest rates, in fact, are rising. And they're rising because we're seeing some inflation, and there's the Fed change is happening, which is creating some uncertainty there. And rising interest rates will impact both the middle leg of the E and the bottom leg of the E, not so much the upper end. The people who have income and money, they just live their life. I mean, they're in another planet. And fortunately, they do drive a high percentage of retail sales. So, but I would expect interest rates, along with energy prices, to start squeezing things as well. And as Michael pointed out, when the war ends, the question now is how long is it going to take to get production back?
Well, here's my question then. And it goes back to what you've all kind of hinted at here. If we've got 70% of the economy is based on consumer spending, have we seen a paradigm change? Because Wall Street does not seem to be bothered by this. I find it almost difficult to believe that one demographic is propping up this entire economy. So has the paradigm changed that consumer spending doesn't mean as much? It's all on AI now as far as the stock investments go? I mean, stock prices going up?
I think
you just changed the subject from the economy to corporate profits.
I know, you've said that before.
Corporate profits are growing all broadly, but the big growth is happening as a result of the AI spending. I mean, we're talking about 2 or 3 companies are spending $700 billion on data centers over the next, I assume, few years. And then there's many other companies are spending money too. So we're north of $1 trillion this year on one thing or other for AI. And that's a lot of money. I mean, that's not a small amount. And that's high profit margin business. These companies make huge margins. I was raised by an accountant, margins that were unheard of when I was as young as Kristen.
Well, I don't think we can overstate the importance of this data center build out and the infrastructure with AI, because it really is driving a lot right now. It's not just the chips that are being used in AI, but it's Caterpillar, it's Corning, it's the fiberglass, it's the shelving. It is every part of the U.S. economy is being touched with the build out of these data centers. And I think the big question, and I know that we've touched on this before, is what's the return on that investment and how does it play out to the general economy? But that is really propelling markets forward during this time where we should see market pullbacks.
Well, it's interesting also because there was, I think you probably all saw it, an article in the Wall Street Journal today, it started last night, and that is the American rebellion against AI is gaining steam. It notes that the local opposition blocked or delayed 48 data center projects valued at $156 billion last year. 20 more were canceled in the first quarter of this year. Politicians are now starting to side with the people who are afraid of these data centers in their areas and the rising cost they believe for them because of that. And, you know, headline after headline says, you know, we're going to see a loss of jobs because of AI. People are scared about it. So I know nobody probably has the answer to this, but what exactly do these tech companies do now if public sentiment is not in their favor? Because once public sentiment goes one way, the politicians start to go that way.
Well, do they? Do they? I'm thinking that this is me at my most cynical. I try not to be cynical. You know, it's all in the donations, or what do we call them? You know, political
Contributions.
There we go. So yeah, don't underestimate a politician to go against the people for, you know, remuneration. We'll call it that way.
It all depends whether he's in Congress and has to be reelected every 2 years, or whether he's in the Senate and he's got 6 years and this thing can pass him by a little bit if he's just been recently reelected.
That's true. That's true. But I think there's a larger issue here that in their zeal, and I mean, these are the top companies: OpenAI, Anthropic, to a lesser extent X with their XAI. They were all promising that the big brain has been created, right? And that it was going to replace people, and we were going to lead these lives of leisure. All we had to do was fork over all of our data and let the machines work for us. So, as I have argued intensely for years, while I believe in AI, the big brain that replaces the people is not a thing. But these people who are trying to outperform each other and say that, no, I have a conscious AI over here, or AGI, I guess that's artificial general intelligence, which no one has had, no one's going to have. The large language model, which gets all the press, is interesting. It's solved some problems, but it is not the big behemoth that is going to replace humanity, sorry. But they're reaping what they've sown. And they have put fear in people's hearts that don't know what it is and how it works. And they're going to have to work through that. Boo-hoo. They did it to themselves. But that being said, I've always been a believer, too, that all the promised data centers weren't going to come online either. Technology is this crazy thing that at the beginning, they say, oh, we're going to need this much space. Do you remember when a computer was like the size of a small, you know, 2-bedroom house? And now, whatever computing power that was, we carry around more than that in our purse or pocket with our phone. I think that's what is going to happen rapidly with AI, that they are not going to need the huge footprints that they're estimating now. So that will bring down the spend over time. It will certainly bring down animosity. And nobody really wants these whirring, power-consuming places kind of humming along where, I don't know, farmland used to be, right? Like, it's just a bad look for the industry, and they'll figure that out. But we're definitely in a rocky period where people are pushing back, and, you know, zoning matters. They're just going to have to work it out, like all other industries have had to work it out.
I think the AI companies, whether it's OpenAI or Anthropic, did a horrendous job with their PR campaign regarding AI. Horrible. Yep. I agree with Kim. I don't think there is going to be mass layoffs, mass unemployment there. You're actually kind of seeing the opposite in many instances where AI is actually creating more demand for those jobs. I just gave a presentation this morning about call centers and how call center work is actually, there's more hires for those types of people because that more demand is creating actually more customer interactions there. So there will be displacement, just like any sort of technological revolution, without a doubt, but it's not going to create mass unemployment at all. I just think these AI companies did a terrible job coming out to the public and talking about what it really means to people. And you can complain all you want about data centers and AI, but you can't, inevitably this is going to happen. We are, whether it's us or China or whatever, I don't think, they talk about how the US government doesn't want to lose to China in this AI race at all. So there's going to be a continued massive build out in the US. I kind of agree with Kim in terms of the data centers and how big these need to be and what that will look like. And Musk will have these in outer space pretty soon anyway, probably, right? So, that could be a moot point for the most part. But AI, by no stretch of the imagination, is going away because there's a little bit of a public outcry, or people are booing it, commencement speeches or whatever. Just not going to happen.
Yeah. It's. I think you hit it, all of you. That it's a very poor PR job. Even the president has basically said they need some help on this thing. I think they were so excited about look what we've got that they didn't think of the ramifications of exactly what they were saying. And the way social media is now, somebody picks up this, and the next thing you know, it's twisted and turned, and everybody thinks that AI is here to kill all of us. So.
And if it were that great, it would have done the PR job for them. They failed to do it.
Oh, that's good. I like that. Let's go back
Frank.
to investing. We've talked about this, the global hit because of oil prices. Does this, and we've seen Europeans are facing problems with this. Southeast Asia is facing problems with this. China is faltering a little bit. Its exports are still high, but its economy is faltering a little bit. Maybe not just based on oil, but does this change your perspective on international investing at all?
So it does not for us. So we historically have been very low international over the past decade, and then in early 2025 we started to re-enter international markets or increase exposure there. And there definitely are challenges. Last year was a great time to be exposed. Now, not so much, or there's just more risk involved. And really, it is about, we want to create diversification. One of the problems and one of the reasons we were low exposure for so many years is because they were moving along with U.S. markets, just not quite as well. And so to be able to see, the correlations there break up a little bit is a positive thing, but we're definitely not increasing exposure at this point in time. Just kind of staying where we are. This is why we always talk about rebalancing and believing in the strategy and knowing our clients' risk tolerance and all of that, to be able to see some of this uncertainty through over the next several quarters.
What about, go ahead, I'm sorry.
The rebalancing thing is a very difficult thing for people to deal with. And the reason is it requires you to sell what's been doing well and buy what's been doing badly, and to get it rebalanced, which is counterintuitive to what people emotionally do. And AI isn't going to fix that. And people like Kristen and Michael and my son are faced with that battle every day of getting people to understand the object is not to buy high,
Yeah.
to buy low. And
Buy low, sell high,
There's four
right.
words that are always true: buy low, sell high.
Yep.
And as far as AI, it's not different this time. It's going to be just like every other transformation. How long it takes, who knows? It'll probably happen faster because of computers. Maybe.
Well, let me rephrase the question then a little bit. If you hesitant or not hesitant, but you have a thought process right now on investing in international companies, what about U.S. companies that do a lot of business internationally? Does that change at all?
So this is how I like to play the market, because I'm buying individual stocks. I'm not. I'm buying individual stocks, not ETFs or mutual funds. That generally, whenever you're buying those, they can and may have bought things overseas. They certainly have analysts that understand the accounting practices in each country and each area, geography, and you're scratching your head going, well, isn't accounting? Nope. Especially where it comes to their security trading rules. Some places allow insider trading, for example. Anyhow, back to the task.
You mean like Congress?
Yes, don't even get me started. Don't. Just, it's a real sore issue for me. Anyhow, but I prefer to use American companies that have large exposure to other areas of the world. That way I know there's a little bit of buffering because they probably have some US exposure. But if it's a company like, and we don't currently own this, but it's a great example, IBM, 60% of their revenues comes from outside of the US. So if you buy that US domiciled company and US traded company, you're really getting exposure to a lot more of the world. And I have always preferred to do that rather than trying to either buy directly or use a mutual fund.
So, kind of going back, Stacey, to your question on just international more generally. We own international now. We've been slightly underweight international, but if you look at, we think it can do kind of well, assuming that the war in Iran can get resolved in a somewhat timely manner. I mean, the Federal Reserve is the only central bank out there that, at worst, is probably going to keep rates unchanged. I doubt they cut this year, but every other central bank across the globe, whether it's the Bank of England, the ECB, the Bank of Japan, are raising interest rates. And typically, that essentially means that the dollar could weaken against those other currencies. And when dollar weakens, generally U.S. underperforms international stocks. But having said that, what kind of concerns me a little bit about the U.S. stock market is I'm a little bit worried that we are really, really banking on artificial intelligence and that really kind of not having a falter. If you look at the semiconductor industry, that is the biggest industry now in the U.S. It is half of information technology now. So a company like SanDisk is up 3,600% in the past year. So these stocks have just gone on an absolute tear. They are relatively expensive, or at least trading well above their 40-week and 10-week moving averages. So if you see a hiccup in that industry, I think that could pull down technology, that could pull down the broader market. Again, probably temporarily, not a significant recessionary signal here, but having a little bit more diversification outside of the U.S. market, which is now 50% tech and communications, I think it's a benefit to investors.
If you're worried about, shouldn't say worried. If you're concerned about some of these tech companies that have surged, like you just pointed out, do you back off from those? Going back to what Frank was talking about, rebalancing your portfolio, or do you hang on to those?
Well, it depends on that. That'll probably be a Kim question more than a Michael question. But it's not that I'm concerned. I think it's just something you really need to pay attention to. I mean, those stocks have really ripped. If you own again, I brought up that stock SanDisk. If you own that in a taxable account, it's up 100% this year. A lot of people don't want to pay don't want to pay the taxes on that, and they just kind of end up holding them for better or worse. And again, I'm not one to predict what's going to happen in those stocks over the next couple of months or so. I think if you believe in the company, you believe in the fundamentals, and continue to maybe hold on to it. But it's something that you need to be cognizant of in your portfolio.
So a couple of things here. I think anytime you have an overweight position, let's call it more than 8% of your total portfolio, you really need to pay attention and maybe sell some of it. And if you're going to have to pay taxes on it. I'm really sorry. But that's just prudent. I don't feel bad for you. I pay taxes. We all pay taxes. This is, the price of success, right? So taxes aside, you need to seriously consider selling some of these winners if you have a basket full of them. Now, as a corollary, and I don't know if corollary is the right word, but something that I kind of started doing whenever I started the strategy that I'm running in 2020, I was looking for newer, more exciting software companies, and I realized I can't buy into them. They're mostly private, they get really big, and then they're bought by an existing company. So the way that I played that was I decided I would buy semiconductors because I may not be able to own directly the new exciting software companies, but I know that they're going to use silicon and semis to run on. Okay, so it's kind of a level of indirection away from whatever the new technology was. And guess what? I won, like big time, because we had mostly semiconductors and very little software. And it's just because I thought the software wasn't exciting in 2020. Nothing new, no new categories, no new problem-solving companies that we could buy as public companies. Now, shame on the US that we've created this environment where it's very difficult and companies no longer aspire really to become public companies. They want to be sold at some point or live forever in private company land. But I think that is something that is also driving people that want exposure to new ideas into semiconductors as opposed to software, where it would have, even in the 2000s, certainly in the 2000s, but probably up to about 2019. There were still lots of kind of cool, newer, smaller software companies out there that you could, buy, and they all kind of dissolved.
Well, I should tell you this, that while you were speaking, the four of us gathered and were sending text messages that since you don't mind taxes, we'll be happy to have you pay our taxes for us.
No, you guys are jagoffs. And if you're not from Pittsburgh, go look it up. But
Exactly. All right. I'm sorry, I couldn't resist.
that's okay. That was really good, though. Touche.
Yeah.
I was really worried. What are you texting about?
Yeah. Most analysts, of course, say the numbers aren't there for the Fed to lower any interest rates, as Michael just indicated. Everybody else has been raising interest rates. In fact, U.S. Treasury instruments have seen a surge in yields, while the price of these Treasury notes or bonds has been coming down. So, if going back to what Frank said, you buy low and sell high. I know bonds are a little bit different than everything else. Wouldn't this be a good time to buy bonds?
If you are coming from cash, yes. It is now, and it's also going back to your goals. Why are you buying the bonds? What are your goals? We tend to work with clients a lot with laddering their bonds because we don't know. It's very hard to market time bonds. We don't know if interest rates are going to go up. Like, what do the next 12 months look like? So it really is about having a strategy overall. Yes, so we can reduce the risk by laddering the maturity dates of these bonds. If you're in retirement, we try to match them up with some cash flow needs. So there's some strategy behind it there, but it is hard for any conservative investor who lived through 2022. That was a very, very difficult period of time where you had stocks and bonds down, and bonds were really down for bonds. And so I think there's some muscle memory there with every time we get these shakes in the bond market, it's like, is it another 2022? What's happening? Should we get out? So it's really just talking through what does this look like now compared to then, and how is it different?
If you look at the math on bonds, there's two ways you make money with a bond. The interest, of course, which right now is basically paying you inflation rate plus taxes, even on the long end, which means you're earning nothing, unless they're tax-free, or even if it's in a non-taxable account. Sooner or later, you're going to pay tax on it. Somebody's going to pay tax on it. That being said, the other way you make money is by appreciation, or lose money by depreciation, which lately people with bonds have lost money because they've gone down in value. At some point in time, if all the bad things that could happen actually happen, we'll go into a recession. And that will, if one day happen, at that point in time, interest rates will go down to stimulate the economy. Bonds will go up. Now, as Kristen pointed out, it's impossible to time this stuff. There's just no way to know when anything like this is going to happen. So if you want to buy bonds, I've always taken the position that you build positions, you don't take positions. You start, you buy some, and then if interest rates go higher, you buy more. And then if interest rates go higher, you buy more until your position is, you have taken your position. This way, you're not trying to figure out what's going to happen in the next 5 minutes, because you're going to be wrong. And if you're not, you're lucky. And
The only other thing
luck is
I'd
not the
add-
way to manage money.
the only thing I'd add to what Frank and Kristen talked about is we as investors, sometimes people just say bonds and it just they just talk about bonds. They're not really kind of specifying what that means. The bond market is incredibly diverse. You could talk. I don't know if you're talking about treasury bonds, corporate bonds, high yield bonds, asset-backed securities, mortgage bonds, collateralized loans, bank notes. There's good investments in the bond market at any given time in the cycle. So talking about what types of bonds you want to invest in right now, I think is very, very important, as opposed to just blanketly saying buy bonds personally. So whether you want to be long duration, short duration, that's we don't have to get into that conversation now, but there's always not always. Generally, there's a pretty good bond investment out there, again, regardless of where you are in the investment cycle.
There was a headline last week, I believe, also saying that while the U.S. Treasury notes, bonds, whatever, have seen their yields rise and the prices going down, people are still buying a lot of corporate bonds. Is there a particular reason for that? Just because the economy is doing so strong as well, or what?
Well, again, as Mike pointed out, there's at least two kinds of corporate bonds: junk bonds, which I prefer to call them junk rather than high yield, which kind of puts lipstick on a pig. All right, or quality bonds. All right, if you're buying quality bonds, they actually probably normally, although I don't think so today, yield more than the Treasury, comparable term Treasury bond. I'm not sure that's true today. I haven't paid that much attention. Maybe someone else has. But that being said, typically a corporate bond is a higher risk, so it yields a little more than a government bond. But nobody brought up I bonds, which is a total flip of what we're talking about.
Which kind of bond?
And I actually bought a couple of bonds today for some individual bond accounts that I have. And I did, I bought a couple of corporates. I bought a AA and a AAA, and they were yielding higher than the, Treasury, same term Treasury. So yeah, sure, why not?
So you took a minor step down in quality, maybe. We're not so sure of that anymore. All right. Used to be a certainty. Now it's less so.
Well, I really appreciate the way we've all bonded together in this particular session of the Bull, the Bear, and You. We'll continue our look at investing and the economy in future editions. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to use. But that does it for right now. Thanks for joining us. We'll see you again for the next edition of the Bull, the Bear, and You.